Hey guys, good afternoon. Hope you're doing well. We're deep diving today into a topic around hedging. Last week we discussed the calendar collars. Today we're talking about put ratio spreads, which are a phenomenal way to engineer asymmetric downside protection on a position you hold in your portfolio. In this case, we're going to be using Nvidia as a case study. So let's go on. Um, so what is a put ratio spread? This is a very interesting strategy where you buy one put option near the money, so a higher strike put option, and then you sell numerous out of the money puts to finance the higher strike put option. In this case, we're talking about buying one put option closer to the spot price, which is your primary hedge, and then selling two put options further out of the money against that put option, which then pays for that hedge. In this case, the example we're going to use is near zero cost. You can structure these trades any way you want. There are different permutations. You can use wider spreads, narrower spreads, further out of the money, closer to the money. Again, I can't really go over all those because there's so many different ideations around this. And so really it's all about how you want to hedge yourself based on your portfolio structure as it stands. And then the last thing is the protected zone, which is where you have defined gains between the long and the short strikes. So the pros and cons of this strategy, there are numerous advantages. Obviously, there are trade-offs as well, right? The primary advantages are one, as we saw with the collar last week, the calendar collar, cheap or free protection, right? These hedges hedge out large positions in your portfolio for a nominal debit versus buying a put outright, which drags on returns. Um, Typically, if you just buy puts, hedge your portfolio, there's a dragging effect of about 2.4%, I believe I read it a while back, on your portfolio, which over time will add up a lot. The second advantage is asymmetric payoff. Max profit is a large multiple of the cost paid. In the example we're going to use up ahead, I'll explain that as well. The example has pretty much 29 times payoff based on the overall risk discussed. Um, the next advantage is defined protection zone that can be sized to cover an expected move based upon a straddle price. Let's say you have a binary event like earnings, for example, which we'll discuss for Nvidia. This is kind of protection you want through a binary event. And the next thing is that it can be turned into a near zero cost trade, or even perhaps for a net credit, depending on how you structure it. Now, their trade-offs are, the risks are as well, are that the extra short put is uncovered below the lower strike, and so losses will grow if the stock craters, right? A second lower break even creates a renewed loss zone in a severe sell-off, right? So there are two break evens in this trade, obviously. We'll go over that as well. And then there is a risk, obviously, if we get in the money on the second put of early assignment. If we do that prematurely, it's possible you get assigned prematurely, and then it kind of ruins your trade overall. Again, I wouldn't worry about that so much overall, especially if you have the cash in your portfolio or the margin in your portfolio to handle an assignment on a position here. And the last thing is the max benefit is only near the short strike at expiration. Protection is not linear overall. So this is where you gotta pretty much plan your trade out in advance and think about how far out you want to use this trade, right? So the example we're going to use here is if you hold 100 shares, for example, of Nvidia, and you want to guard the downside, right? Using the August 28th straddle, which factors in their earning report, to gauge the market's expected move. The concern is a slide toward lower implied bound. Again, like you want to kind of think about it from the perspective of you hold a position in Nvidia, you're okay with a certain level of drawdown, but in the event of an extreme sell-off, let's say, for example, earnings come in lower than expected and it sells off, far more than the implied move of $24 in one direction, right? That is the implied move based on the straddle price. So the lower bound implied as of today, as of the spot price right now, is 182. Now, you might say to yourself, okay, you know what? I'm okay with a move down of like, $10, $15 perhaps, in which case that's where you build your hedge out, right? Obviously, again, you can permutate the strike prices depending on your desired downside protection of a position. But keep in mind, this will fluctuate the overall credit or debit of the position using a put ratio spread. Now, building the put ratio spread here would entail, and again, this is for August OPEX, August 28th OPEX, which is after the earning event. So you would buy one 190 strike put option, which is your primary downside hedge. You would then sell two of the 175 strike put options, which pay for this hedge. Now, the net debit here is only about 50 cents. Again, it'll fluctuate depending on when you watch this video. But the point is, the insurance is very cheap because buying a put option outright by itself is very, very expensive, right? I think this put option costs about $8 as I speak right now. It's actually, let me just check for you guys right now. So if you're buying that put by itself, it's $5.20 right now, right? So that's the cost you'd incur if you were buying just a put by itself. In which case, if Nvidia remains above 190, what happens to your hedge? Let's say it expires worthless. You just paid $5 overall. That $5 is an added cost to your current position. So let's say, for example, your spot price, your cost basis is 200. You would add $5 and change to that cost basis, therefore increasing it to 205, which you don't want to do. In this case, the cost is only 50 cents. And your zone where you have protection here is between 190 and 175, where your max profit resides. Keep in mind, the implied floor here on earnings or downside is 182. Now, the max profit here is $14.50 if we land smack dab on 175 into expiration on August 28th, which is not a likely occurrence. But again, we have insane asymmetry of risk here where you're risking 50 cents for upside of almost $15 overall, right? You have upside of 29 times your overall cost basis on this trade. Now, where are the strikes on Nvidia overall, right? So spot price is 206, somewhere around here. Your protected zone is between 190 and 175. Now, because you own the 190 put option and you're short two of the 175 put options, as we go below 175, the benefit diminishes up until the point of 160.50, where your second break even resides. Because your first break even will be at expiration will be 190 minus 50 cents, so 189.50. And your second break even will be at 160.50, for example, right? Because think about what happens at expiration if we land at like 160, right? The 190 put option is worth what? 190 minus 160 is 30, right? That's $30 in your pocket. But each of the 175s is worth negative 15 times 2 is negative 30. So positive 30 plus negative 30 is 0, right? Your cost is 50 cents. Therefore, your break even is 160.50. Again, this is a great way to express your trade because looking at the chart on Nvidia as well, over the last 1 year period, the year low is about 165 or so, which means that we're hedging out a perhaps an event risk of earnings where a surprise happens to the downside. But again, the probability of us hitting that 160 area is so minute that the probability of making a profit here is actually very high without incurring a loss on it extending past these strikes and below the second break-even zone overall, right? So when you're structuring your trades, you want to look at the chart and kind of figure where is an area where we're unlikely to actually go, but also it gives me enough protection where the spot price to the first strike price is sufficient such that if we get there, I don't really care so much. That's my downside protection into earnings, for example, right? So in this case, we're at 206 to 190. You might say, you know what, I'm holding Nvidia longer term. I don't really care so much about a drawdown of 16 bucks per share on earnings. But if it sells off heavily to like 175, you want to have that protection in place, which then perhaps can be used if you monetize it to buy a new position on Nvidia perhaps later on, assuming that your thesis remains intact. Now here's the profit and loss zone on or profit and loss across the prices on Nvidia overall, right? So we kind of discussed this already. Same thing, max profit 1450 at 175 at expiration. Upper break evens 189.50, lower break evens 160.50, and the cost here is only 50 cents. Again, one thing to add as well is that you'd want to perhaps build out this trade before the event itself, not so far in advance. I'm using this as an example because we have Nvidia coming up in about a month and change. But again, it gives you time to think about the structure you want to have on a position you have in your portfolio. It doesn't matter if it's Nvidia or Microsoft or S&P correlated assets, for example. You can use the same structures discussed here on any position in your portfolio overall, and that's where you can hedge out risk. The one thing I would note is that you wouldn't want to hedge out positions where you have a lot of implied move, perhaps like a name like SpaceX or a Tesla, for example, using the strategy because typically speaking, if you get an exaggerated move to the downside, it'll elicit a loss if it goes far, far below that short strike where you're short two contracts. So keep that in mind as well. This is best used perhaps on like Google, Microsoft, Nvidia, like Amazon, Meta, perhaps. Any name that's a blue chip name that you don't expect a crazy move to the downside. Microsoft, for example, right? These names typically won't move 20% plus on a given day, right? So here are the key takeaways, right? One, this is a cheap targeted insurance, right? You have a low debit. If you want to structure this more narrowly, for example, if you go like a 190, 180, you can structure it for a credit perhaps, but you got to think about it from the perspective of you want to be wide enough to be able to, one, monetize, and also two, not have it shoot through all your strikes so as to elicit a loss on an exaggerated move to the downside, for example, right? Second thing is asymmetric reward, right? Here you have maximum profit of 29 times your overall cost, which means you're not really losing much overall if you lose, right? But if you get a payoff, let's say you get a payoff of even 10x or 15x, for example, that's a very nice benefit to your position, wherein you can then use the proceeds perhaps to purchase more shares, assuming again you're still bullish on a name like Nvidia on a downside move, right? We've seen numerous times that Nvidia's rallied into earnings and then they've had a phenomenal report, but what happens? They sell off right after. Last quarter, they went to, I think, 235 before earnings. They fell from 230-ish down all the way down to 212 following their report. The next thing is know your tail risk, right? So below 160.50 break even, the second break even, the extra short put option will actually start hurting you, right? If we fall, for example, to 150, in this case over here, or over here, for example, right? What happens here? Well, the 190 put option ends up being worth what? 190 to 150 is 40, but each of the 175 puts end up being worth 175 minus 150 is 25 a piece times 2. That's minus 5,000. You're only positive 4,000 on the 190 put option. Therefore, you're down $1,000. This is what I mean by the risk is great when you have an exaggerated move far beyond the middle strike, which is why it's good to use it for with names that don't tend to move 20-30% after earnings. Like, for example, IBM a few weeks ago, or I think last week, went down 25% in one day, right? I don't expect that to happen with an Nvidia or Microsoft, for example, right, or Google. And the last thing is, it's best when you expect a moderate pullback within the implied move, as I said, not a catastrophic crash below the short strike. That's all for today, guys. If you have any questions at all, drop them below in the comments. If you have a position you want to talk about, for example, or you want to share with me, and you want my input, drop it in the comments as well. I'll be happy to respond. Or reach out to me on my website, which is optionfinity.com as well. That's all for today, guys. Trade safe, be well, and talk to you guys soon.